Welcome to this new webinar titled Forex 101, brought to you by iForex. Without further ado, let's dive in and explore these new interesting terms. First things first, let's go through the agenda. We're going to talk about the history of Forex, how everything started, the daily turnover, very impressive number by the way, the trading sessions, what time the people, the investors, the traders around the world trade, and currency pairs. Will go through the anatomy, if I may use this term, of a currency pair, the spread, the cost of trading that is, the lot, the size, the very popular size of a trade, of a position size, a pip. We're going to talk about the pip, the smallest unit in an exchange rate, the pip value, how we're going to calculate a pip's worth, and of course, profit and loss. We're going to learn how to calculate the profit and loss, and last but not least, leverage and margin. Very important terms. So, back in 1944, at the end of World War II, the United States of America invited their allies to meet at Bretton Woods at New Hampshire. There they wanted to find a new monetary system to rebuild Europe, so they decided to peg their currencies to gold, which was convertible to that time at 35 US dollars per ounce. Yes, you heard that right. $35 per troy ounce. That was the price of gold back in 1944. So this agreement, this conference, is known as the Bretton Woods system. So all countries that participated agreed to peg their own currencies to the US dollar plus or minus 1%. So in 1971, the United States abandoned this fixed value of the dollar and allowed it to float, allowed it to be the price to be determined by demand and supply. By 1973, of course, the rest of the participating countries of the Bretton Woods Agreement agreed to allow their exchange rates to float as well. Today, most currencies around the world are freely floating, and the price is determined, of course, by the demand and supply of each economy. So, what is Forex? This is the question. The foreign exchange market is the place, in quotes please, is the place in quotes where currencies are traded, which means exchange for one another. I said in quotes, foreign exchange is the place in quotes because there is no such a physical place. There's no physical place called Forex or foreign exchange market. It's not a centralized market, but it's a decentralized market. That's why there is no physical building place called the foreign exchange market. Excellent. So when you buy one currency, at the same time you sell another. So the Forex market works in pairs. You buy one and you sell at the same time another. For this example here, euro dollar, if you buy euro, then at the same time you will sell the equivalent in US dollars. Very interesting chart here, by the way. Let's go back to 2001, where the daily turnover in the Forex market was just 1.24 trillion US dollars every single day. Then in 2004, it was almost 2 trillion US dollars a day. Then 3.32 trillion US dollars per day, daily turnover that is. Then in 2010, almost 4 trillion US dollars. And then 5.36, 515, and 659 in 2019. And the last statistics that I have is 7.5 US trillion daily turnover back in 2022. So there is a lot of money being exchanged every single day in the Forex market. Market distribution, most of this activity is visible, is manifested, is done in the London session. And then, of course, in the New York trading session. These two sessions, the London and the New York, constitute the biggest part of this activity. The rest of the sessions have much less of an activity, that is. So, trading sessions. These are not fixed times. It's a rough estimate. So the London session starts about more or less 8 o'clock in the morning and ends like 5 o'clock in the afternoon. But when New Yorkers or traders in the New York trading session wake up, they might start trading 1 o'clock. So there is an overlap with the London session, and they will stop trading around 10 o'clock at night. And then the Sydney session starts, right? The Australians wake up and start trading, and there is an overlap with the Tokyo session. And most of the traders around the world prefer the overlap between the London and the New York session. Currency pairs. What is a currency pair? Of course, the currency pair consists of two currencies. The first, the leftmost currency, and the rightmost currency. The left currency, the first currency, is called the base currency. This is what we have to call it from now on. The base currency, in this case, is the euro. And the second currency, the leftmost currency, is called the quote currency. So when we say Euro USD is 1.3, what does it really mean? It means that to own 1 euro, you need the equivalent of the US dollar, which is 1.3. So 1 euro is equal to 1.3 US dollars if the exchange rate of the Euro USD is 1.3. Now, let's have a look at the most important currency pairs. These pairs are called the majors, and they have nicknames as well. So the first pair is Euro USD, and we call it the euro. The second one is GBP USD or pound sterling US dollar, and we call it cable or sterling. Australian dollar US dollar is called the Aussie, and US dollar Swiss franc, we call it Swissy. US dollar Canadian dollar Loonie, this is the nickname. US dollar Japanese yen, we call it dollar yen. And of course, New Zealand dollar, US dollar, we call it Kiwi. Good, let's take a look at some of their features. They are very liquid, so you can buy almost any time, any amount. Almost. This is what liquidity is all about. There is a lot of money there to accommodate big trades. They constitute about more or less 80% of the daily Forex market volume. So they are heavily traded. They are less volatile. Their swings, their movements are tight. They are not wild, that is, and they are less susceptible to manipulation. It's not easy to manipulate these prices. And of course, they have tighter spreads. Their cost is low. This is what it means. And now the second group is called the crosses. The crosses are the pairs that do not involve the US dollar. The crosses, they do not have the US dollar in the pair. The first one is Euro Japanese yen, then New Zealand dollar Japanese yen, pound sterling Japanese yen, Euro GBP, Euro Swiss franc, and Australian dollar Japanese yen. Their features, their characteristics, they are less liquid compared to the majors, more volatile compared to the major, more susceptible to manipulation compared to the majors, and they are riskier to trade due to their sensitivity to sudden political and financial developments. And they have higher cost, wider spreads. The last group of the currency pairs that we are going to discuss today is the exotics. These are currency pairs that involve a currency of an emerging economy. For example, Euro Turkish lira, US dollar Turkish lira, US dollar Mexican peso, US dollar South African rand, and US dollar Singapore dollar. Their characteristics, not liquid compared to the other two groups, of course, very volatile compared to the crosses and the majors, more susceptible to manipulation compared to the other two groups, and they are risky due to their sensitivity to sudden political and financial developments. And they have huge spreads, huge in quotes, compare always to the crosses and of course to the majors. The cost of trading the exotics is higher. Now, what is spread? A very important term. Spread is the cost of trading. But let's analyze it. And in currency pairs, there are two prices actually, the bid and the ask price. So currency pairs are quoted in bid and ask prices. Bid is the price to sell the base currency, while ask is the price to buy the base currency. When we talk about currency pairs, we always buy and sell the base currency. Now, the difference between the ask and the bid price is what we call the spread. One more time, the difference between the ask and the bid price is the spread. For example, let's say Euro USD has an ask price 1.2053 and the bid price, the price to sell, is 1.2052. If we do the subtraction, then the answer is 0.0001, which is 1 pip actually. And this is the spread, 1 pip. So what is a pip? Excellent. Pip is point in price, is the smallest price unit in a currency exchange rate. It is usually the fourth digit after the decimal point. For example, in the Euro USD, 1.3053, the fourth digit after the decimal point is 3, and this corresponds to 3 pips. Next example, GBP USD, the fourth digit is 9, right, in the exchange rate, and this means that we're talking about 9 pips. Pips correspond to the fourth digit after the decimal point. Now, an exception to this rule is those currency pairs that involve the Japanese yen and the Hungarian forint. For example, US dollar Japanese yen 98.21, 1 pip. In this case, is not the fourth digit, but the second digit after the decimal point. And another example, Euro Japanese yen, again, the pip corresponds to the second digit after the decimal point, which in this case is 3 pips. And last is the US dollar Hungarian forint. Here, again, is the second digit after the decimal point. And of course, you got it right, is 5 pips. So, most of the currency pairs, the pip corresponds to the fourth digit after the decimal point, where in currency pairs where the Japanese yen and the Hungarian forint are involved, then is the second digit after the decimal point. Excellent. Let's move on. Nowadays, the currency exchange rates have 5 digits. So in this case, the fifth digit is 2/10 of a pip. In this first example, Euro USD with exchange rate 1.30532, it's 3 pips and 2/10 of a pip. The second example is GBP USD 1.55191, is 9 pips and 1/10. And for the currency pairs where the Japanese yen and the Hungarian forint are involved, then we have a third digit in the exchange rate, which again is 5/10, 2/10, and 6/10 in these 3 examples. This fifth or third digit is called sometimes pipette, right? Excellent. So what is a lot? A lot is a trade size, it's a position size, it's a very known term. Not all platforms use lots. Some platforms use just a number of dollars, euros, and the likes. So what does it mean, a lot? What does it mean? Euro USD, one lot of Euro USD simply means 100,000 euros, 100,000 units of the base currency. GBP USD, one lot is equal to 100,000 units of the base currency. In this case is the British pound, and in US dollar Japanese yen, one lot is equal to $100,000. US dollar is the base currency in this pair. Now, there are three types of lots. Standard lot, which is 100,000 units of the base currency, mini lot, which is 10,000 units of the base currency, and micro lot, which is 1,000 units of the base currency. So in some platforms, you can use 1 meaning lot, 0.1 meaning mini lot, or micro lot, which is 0.01. Some other platforms, you just plug in the amount that you want to buy or sell. So let's see how we can calculate a pip's worth. So how much is one pip worth per 100,000 of the base currency? So look at that, the formula is very simple. Amount of base currency. Let's say we're talking about one lot, which is 100,000 units of the base currency times pips. Now the trick here is to use the decimal notation for pips, like 0.0001, right? So in this case, Euro USD, one lot is 100,000 units of euro, right? Times one pip in decimal notation, 0.0001. And if you do the multiplication, simply you get 10 US dollars, 10 units of the quote currency. Look at that, Euro USD, the lot is in euros in the base currency, where the result is in the quote currency, the US dollar. Similarly, GBP USD, one lot of pound sterling times one pip is equal to 10 US dollars, because USD is the quote currency here, and USD Swiss franc, $100,000 times one pip is 10 Swiss francs. But in Euro Japanese yen, 100,000 euros, one lot, that is, times one pip is equal to 1,000 Japanese yen, because here we have the second digit as the position of the pip, right? I'm sure you got the idea. It's straightforward. The formula is amount of base currency times pips, pips in decimal notation. This is what you have to remember here. And of course, the answer is in the quote currency. Let's take a look at leverage. Platforms offer leverages, so you can multiply your trading potential. And there are different types of leverages. For example, 1 to 100, 1 to 200, 500. It depends on the jurisdiction, regulation, country, and the likes. For example, let's say we deposit $10,000 in our trading account with a leverage of 1 to 100. What does it mean? It means that our capital, our deposit, will be multiplied by the leverage, by 100. So now, with 1 to 100 leverage, our 10,000 becomes $1 million trading capital. So we maximize our trading potential. Yes? Listen to this. Leverage gives an investor the means to increase their trading capital and the opportunity to optimize the outcome. Let's go through an example. So, deposit 10,000 euros with a leverage of 1 to 100. The arithmetic is very easy. It's 10,000 euros times 100. 100 is the leverage. Is equal to 1 million euros. 1 million euros trading capital, right? So let's say I want to buy Euro USD at 1.3055, and I expect this currency pair to move higher. So when indeed it moves higher, I close my position at 131.55. How much is my profit? If I do the subtraction, is 0.0100, which is 100 pips. How much profit did I make? Very simple. 1 million was my position, right? 1 million times 100 pips is equal to $10,000. I deposited 10,000 euros. I made a profit of $10,000, about more or less. I doubled my money. Not bad, right? Excellent. So let's take a look at another example. I deposit 10,000 euros, again here, with a leverage of 1 to 100. Now, my trading capital is again 1 million euros. I buy long position means buy. I buy at 1.3055 and I expect the market to go higher, but instead I close the position lower because the market moved against me, and I close the position at 1.3005. So the difference is 0.050, which is 50 pips. I lost 50 pips. How much in dollars? So it's 1 million euros. 5 times 50 pips is equal to $5,000. Very good. So this is the formula here. Amount of base currency times pips is equal to the value in cold currency. So in a nutshell, I almost lost half of my money. I deposited 10,000 euros and I lost about $5,000. So what is margin? One more term to go through, to understand, to comprehend. So since the trader is allowed to use more capital due to the leverage, of course, we just saw 2 examples. So since we are allowed to use more capital than what we deposited because of the leverage, then the amount, so the broker requires a collateral known as margin to ensure that any losses are covered, right? So take a look at this example. So the initial deposit is $20,000 and the choice of the leverage is 1 to 1,000 now. Now, the required margin is 1 divided by the leverage, which is 1 over 1,000 or 0.1%. Now, $20,000 times 1,000 is equal to 20 million US dollars. That's our trading capital. So we decide to buy 2 lots of Euro USD, which is equal to 200,000 euros. Once again, we just deposited $20,000, but we buy Euro USD 200,000 euros worth. At what price? 1.3. Excellent. Now, we can convert the 200,000 euros into dollars if you wish by multiplying the 200,000 euros by the exchange rate, which is 1.3 and is equal to 260,000 US dollars. Now, the required margin in dollars is $260,000 times 0.1% or $260 margin. So at all times, we need to have $260 in our trading account. This is the margin that we talked about a while ago. So to open a big position, in this case, like $260,000, we need to have in our trading account $260. This is margin. And before I let you go, let's talk about the long and short. In Forex, a trader makes profit when he or she buys low and sells high. This happens in any other industry, of course. We buy low and we sell higher. This is how you make a profit. In Forex, the order does not matter. It doesn't really matter what you do first, whether you buy or sell, as long at the end of the transaction, you buy low and you sell high. One more time. In Forex, it doesn't really matter whether you buy first or you sell first. What matters is at the end of this transaction that you bought low and you sold high. Look, in this case, we buy first here at 1.3 and then we sell at 1.3050. So this is called long. And this is the regular way to make profit. You buy low, you sell higher. You buy first and you sell later. Also, you can go short. You can sell first, let's say at 1.5560, and then you can buy at 1.5505. So you can make a profit. So you buy lower and you sell higher. But again, in this case, we sell first and then we buy. At the end of the transaction, we bought low and we sold higher, but the order is insignificant. This is what I had for you guys. I hope you enjoyed it and learned something new. You want to understand markets and technical analysis better? Follow iForex for more quick and easy guides to trading. Stay tuned for more.